Game over. China's silver vaults will be exhausted in 10 weeks. 3 weeks ago, a number appeared on the Shanghai Futures Exchange vault report. A number that should not exist. 900 tons of physical silver vanished to 423 tons in just 7 weeks. Every single day, the inventory dropped. Not once did it rise, not even by a single ounce. The drain rate, 10.78 tons per day, and it's accelerating. At this pace, the vaults will hit zero in 70 days. But here's what nobody is telling you. When exchange silver disappears, it doesn't just affect traders. It fractures the entire supply chain. Solar panels, semiconductors, medical equipment, electric vehicles, all dependent on steady silver supply. And when the vaults run dry, the question isn't whether the price will rise. The question is whether you'll be able to buy it at any price. What happens next is not a prediction. It's already in motion. Welcome to Metal and Macro. You know, back when information actually meant something, people didn't scroll past numbers that didn't add up. They stopped. They investigated. They understood that markets don't lie, only the people interpreting them do. If you're someone who still believes in doing your homework, in seeing what others choose to ignore, then you're in the right place. Go ahead and subscribe. Not because everyone else is doing it, but because you understand that in markets like these, the difference between being prepared and being blindsided is the quality of information you allow into your decision-making process. And before we go any further, drop a comment below and tell us, where are you watching this from? Are you in North America, Europe, Asia, the Middle East? Because what's happening to silver right now isn't isolated to one region. It's global. And depending on where you are, the impact will hit you differently. So let us know. We read every single comment. Now, let's get into what's really happening. A researcher sat at his desk on a Tuesday morning in mid-January, scrolling through commodity data like he had done 1,000 times before. Nothing unusual, nothing alarming, just numbers. But then, he stopped. His cursor hovered over a single line in the Shanghai Futures Exchange vault report. The number didn't make sense. He refreshed the page. Still the same. He checked the date, checked the source, checked his own spreadsheet formulas. Everything was correct. And that's when the question formed in his mind. Where did all the silver go? The Shanghai Futures Exchange, known as the SHFE, is not some obscure trading platform. It is one of the largest commodity exchanges in the world. Every day, it publishes official vault inventory reports. These are not estimates. These are not projections. These are audited numbers, representing physical bars of silver sitting in warehouses across China. Real metal, real vaults, real accountability. On December 15th, 2024, the SHFE reported approximately 900 tons of physical silver in its vaults. That number had been stable for months. Sometimes it went up by a few tons. Sometimes it dropped by a few tons. Normal fluctuations, the kind of movement you expect in a functioning market. But then, something changed. By early January, the number had fallen to 750 tons. A noticeable drop, but not yet alarming. Markets move, inventories shift. That's normal. But the researcher noticed something else. Every single day, the number went down. Not most days, not on average. Every single day. He opened a new spreadsheet and began tracking it manually. January 10th, 680 tons. January 15th, 620 tons. January 20th, 570 tons. January 25th, 510 tons. February 1st, 462 tons. February 4th, 423 tons. 6 weeks of consecutive declines. Not one day of inventory replenishment. Not one ton added back into the system. The researcher leaned back in his chair and stared at the screen. This wasn't a market fluctuation. This was a one-way door. Silver was walking out of those vaults, and it wasn't coming back. He did the math. 900 tons to 423 tons in 7 weeks. That's a drawdown of 477 tons. More than half of China's main exchange, silver, gone. The weekly drain rate, 68 tons per week. The daily drain rate, 10.78 tons per day. And when he plotted the data on a chart, the line wasn't just declining, it was steepening. The drain was accelerating. Now, numbers without context are just noise. So let's add context. Combine the SHFE vaults with the Shanghai Gold Exchange vaults, and you get roughly 900 tons of total exchange accessible silver in China. That's approximately 29 million ounces. Sounds like a lot. Until you realize that global silver consumption exceeds 1.2 billion ounces per year. China's entire exchange inventory represents less than 3% of annual global consumption. And at the current drain rate, it will be completely exhausted in 10 weeks, not 10 months, not 10 years, 10 weeks. The researcher pulled historical data going back 5 years. He examined every period of inventory decline on the SHFE. There had been drawdowns before, seasonal patterns, industrial demand spikes, temporary disruptions, but never had the exchange experienced a sustained, uninterrupted, accelerating drain like this. Every previous decline had been followed by stabilization, then replenishment. Miners delivered metal, traders repositioned, warehouses restocked. That's how commodity exchanges function. But this time, there was no stabilization, no replenishment, no correction, just relentless, methodical, one-directional drainage. He cross-referenced the data with CEIC, one of the most respected economic data platforms in the world. The numbers matched. He checked Bloomberg terminal data, same story. He went to the SHFE's own official website and downloaded the raw vault reports. Every single data point confirmed what he was seeing. This wasn't a reporting error. This wasn't a data glitch. This was real. And if the trend continued, China's silver vaults would hit zero by mid-April. But here's what made him pause. The price of silver was falling. In a normal market, when physical inventory drains at this rate, prices explode. Supply and demand, basic economics. But silver had dropped from $32 per ounce in mid-December to under $20 by early February. Inventory collapsing, price collapsing. That shouldn't be possible. Unless something else was happening, something the price wasn't reflecting, something the market wasn't pricing in. The researcher saved his spreadsheet, closed his laptop, and sat in silence. He had just documented a data anomaly that most people would scroll right past, but he knew what came next. He had to figure out why. And that question would lead him somewhere he didn't expect. The researcher didn't sleep well that night. Numbers kept running through his mind: 900 tons, 423 tons, 10.78 tons per day. But it wasn't the numbers that kept him awake. It was the silence around them. No headlines, no analyst reports, no emergency meetings. The silver vaults in China were draining at a historic rate, and the world was acting like nothing was happening. He made coffee at 5 a.m. and opened his laptop again. This time, he wasn't looking at vault data. He was looking for pressure points. Something or someone was pulling silver out of those vaults with mechanical precision. And when things move with that kind of consistency, it's not random. It's coordinated. It's strategic. It's driven by forces that don't show up in price charts. So he started digging. And what he found was 3 converging pressures that had never aligned simultaneously in modern commodity history. The first pressure was industrial. China wasn't just using silver, it was consuming it at a pace that defied historical patterns. He pulled the solar panel manufacturing data. In 2024, China produced over 600 gigawatts of solar capacity. Each gigawatt requires approximately 11 tons of silver. That's 6,600 tons of silver absorbed into solar panels alone in 1 year. But the targets for 2025 were even higher. 850 gigawatts. That's 9,350 tons of silver demand just from solar. And solar was only one piece: electric vehicles. Each EV uses about 1 ounce of silver in its electrical systems. China produced 9.5 million EVs in 2024. That's 9.5 million ounces consumed. And production targets for 2025? 13 million units. Then there was 5G infrastructure. Every base station, every relay node, every switching system. Silver conductivity is irreplaceable in high-frequency transmission. China was building 5G networks faster than any nation in history, and each installation required silver. The researcher added it up. Solar, EVs, 5G, semiconductors, medical equipment. China's industrial silver consumption had grown by 37% year over year, and none of it was coming from domestic mines. China produces about 3,600 tons of silver per year from its own mining operations, but it consumes over 7,000 tons annually. That's a structural deficit of 3,400 tons every single year. The deficit was widening. The second pressure was investment demand. Something had shifted in the behavior of silver buyers. The researcher examined ETF flow data. Physical silver ETFs, the kind backed by actual metal in vaults, were seeing inflows, but paper silver contracts, the kind settled in cash, were seeing outflows. Investors were moving away from promises. They wanted the metal itself. In Asia, the shift was even more pronounced. Retail silver purchases in China, India, and Southeast Asia had surged by 64% in Q4 2024. Coins, bars, small ingots. People were buying physical silver and taking delivery, not for trading, for holding. Then he looked at institutional positioning. The CFTC data showed something unusual. Managed money, the big hedge funds and commodity traders, were net short on silver futures. They were betting the price would fall. But commercial users, the manufacturers who actually need silver, were net long. They were locking in supply. That divergence What told a story? The speculators thought silver was overpriced. The people who use silver thought it was scarce. And when the people who need the metal are hoarding it, that's not speculation, that's survival. The third pressure was supply chain reconfiguration. Global silver production wasn't keeping up. Primary silver mines, the ones that dig specifically for silver, account for only 30% of global supply. The other 70% comes as a byproduct from copper mines, from lead mines, from zinc operations. And those mines weren't expanding. In fact, many were scaling back. Labor shortages, permitting delays, environmental restrictions. Refining capacity was another bottleneck. Even if you mine the ore, you need specialized facilities to turn it into investment-grade bars, and those facilities were running at 94% capacity. There was no slack in the system. Then, geopolitics entered the equation. Peru, the second largest silver producer, was experiencing political instability. Mexico, the largest producer, had introduced new mining taxes. Russia, a major secondary producer, was under sanctions. The global silver supply chain was fragmenting, and China was watching all of it. The researcher sat back and looked at his notes. Three forces. Industrial demand surging beyond historical precedent. Investment demand shifting from paper to physical. Supply chains fracturing under geopolitical and operational strain. Any one of these pressures would tighten the market, but all three at the same time. That creates a feedback loop. Scarcity drives hoarding. Hoarding drives scarcity. And prices lag reality until they don't. Until the moment the system realizes there isn't enough metal to go around. But there was still one piece missing. Why now? Why was China's exchange silver draining at this exact moment in history? The answer to that question required understanding something most analysts had missed. China wasn't just responding to market pressures. China was executing a strategy that had been 15 years in the making. The researcher opened a file he hadn't touched in 3 years. It was labeled China Rare Earth 2010-2015. He remembered writing it during his graduate studies. Back then, it seemed like an isolated case study, a regional trade dispute, nothing more. But now, looking at the silver vault data, he saw the same fingerprints, the same pattern, the same strategic architecture. China doesn't panic buy commodities. China positions. And positioning looks very different from panic. He pulled up a timeline. 2010, China controlled 97% of global rare earth production. These were the elements buried in the periodic table that most people had never heard of. Neodymium, dysprosium, terbium, critical for wind turbines, military hardware, electronics, missiles. And in 2010, China announced export restrictions. Prices exploded. Japan scrambled. The US scrambled. Europe scrambled. But China? China had already secured its domestic stockpiles years earlier. While the West was busy trading rare earth futures, China was quietly accumulating the physical material. By the time the restrictions hit, it was already too late. The researcher scrolled down his timeline. 2015, China began building its strategic petroleum reserve. Quietly, methodically, when oil prices crashed below $40 per barrel, China bought aggressively, not through loud government announcements, through state-owned enterprises, through commercial contracts, through routine purchases. By 2020, China had stockpiled over 500 million barrels, enough to sustain the country for 90 days without importing a single drop. 2016-2023, China's central bank became the world's largest buyer of gold, not in one dramatic move, in small, consistent, unreported purchases. The People's Bank of China added over 1,000 tons to its reserves, and that was just the official number. Independent analysts believed the real figure was closer to 4,000 tons. Gold bought during price weakness. Gold stored in domestic vaults. Gold that would never be sold back into Western markets. 2020-2024. Copper. China accounted for 54% of global copper consumption. But it didn't just consume copper. It controlled copper through investments in Chilean mines, through acquisitions in Zambia and Peru, through refining dominance. By 2024, over 40% of the world's refined copper passed through Chinese facilities. The researcher leaned forward. He saw the pattern now. Rare earths, oil, gold, copper, and now silver. Each time, the strategy was the same. Step 1, identify a critical resource with limited substitutability. Step 2, build structural dependency through industrial consumption. Step 3, accumulate physical stockpiles during periods of price weakness or market distraction. Step 4, control key points in the supply chain, mining, refining, or logistics. Step 5, wait. China didn't need to corner the market. It just needed to control enough of the physical flow that when scarcity hit, It would be the last one standing with inventory. But silver was different. Silver wasn't just strategic, it was existential. The researcher pulled China's renewable energy targets. By 2030, China planned to generate 1,200 gigawatts of solar power. That required 13,200 tons of silver. There was no substitute for silver in photovoltaic cells. Scientists had tried. Copper didn't work. Aluminum didn't work. Silver's conductivity and reflectivity were irreplaceable. Without silver, China's entire renewable energy plan collapsed. And here's what made it more urgent. China had committed to carbon neutrality by 2060. That wasn't a suggestion. That was national policy. Enforced, funded, non-negotiable. To meet that target, China needed to decouple from coal, and the only scalable alternative was solar, which meant China needed silver. Not in 5 years. Now. The researcher pulled up another document, Made in China 2025, a policy blueprint released in 2015, outlining China's goal to dominate 10 strategic industries: semiconductors, robotics, aerospace, new energy vehicles. Every single one of those industries required silver. Semiconductors use silver in conductive pastes. Robotics use silver in sensors and circuitry. Aerospace used silver in engine components and avionics. Electric vehicles use silver in batteries and electrical systems. China wasn't just trying to compete in these industries, it was trying to own them. And ownership required securing the inputs. The researcher noticed something else. The silver vault drainage began accelerating in December 2024, exactly 1 month after the US announced expanded semiconductor export controls, exactly 2 months after Japan joined the chip restrictions, exactly 3 months after the Netherlands blocked ASML lithography machine sales to China. The West was trying to choke China's access to advanced technology. In China's response, secure the raw materials those technologies depend on. If you can't buy the finished chips, stockpile the metals needed to make them. If you can't access foreign supply chains, build your own. And if building your own requires draining every available ounce of silver from your exchanges, so be it. But there was one more layer. The researcher found a speech, delivered in 2023 by a senior official from the People's Bank of China. The topic? Commodity-backed trade settlement. The official didn't mention silver specifically, but he talked about tangible asset reserves and non-dollar settlement mechanisms. He talked about BRICS currency discussions. He talked about reducing dependency on Western financial infrastructure. And he used one phrase that stood out: strategic metal positioning. The researcher sat back. China wasn't just hoarding silver for industrial use, it was positioning silver as leverage, economic leverage, geopolitical leverage, monetary leverage. Because here's the reality: if you control the physical supply of a critical industrial metal, you control the industries that depend on it. And if those industries power the future economy, you control the future. The vault drainage wasn't a market anomaly, it was a feature, not a bug. And the next question was the one that mattered most. What happens when the vaults run dry? Not in theory, in practice. Because empty vaults don't just mean higher prices, they mean something far more dangerous: a fracture in the market itself. The researcher stared at his projection model. 10 weeks. That's how long the silver vaults had left, if the current drain rate continued. But he knew something most people didn't. Markets don't fail gradually, they fracture suddenly. And the fracture doesn't announce itself with a press release. It announces itself with a phone call that doesn't get returned, a contract that doesn't get honored, a delivery that never arrives. He had seen it before. Nickel, March 2022. The London Metal Exchange had to halt trading, reverse transactions, and bail out a Chinese tycoon who couldn't deliver the metal he'd sold. Billions of dollars in contracts, suspended, because there wasn't enough physical nickel to settle the positions. The market had assumed the metal was there. It wasn't. And when reality hit, the entire system locked up. Silver was heading toward the same cliff, except this time, the stakes were higher, the physical paper disconnect. The researcher pulled the futures market data. The Shanghai Futures Exchange had open interest. Contracts representing future delivery, worth approximately 15,000 tons of silver. But the vaults? 423 tons. That's a ratio of 35 to 1. For every ounce of physical silver in the warehouse, there were 35 ounces promised on paper. In a normal market, that's fine. Most contracts get rolled over. Most positions get closed before delivery. Traders don't want the metal, they want the price exposure. But what happens when everyone wants delivery at the same time? What happens when industrial users, the ones who actually need silver to keep factories running, start demanding physical settlement? The exchange has 3 options. Option 1, deliver the metal, but there isn't enough metal. Option 2, cash settle the contracts, pay out the difference in yuan, and hope everyone accepts it. But industrial users don't want cash, they want silver. You can't build a solar panel with a bank transfer. Option 3, invoke force majeure, declare an emergency, suspend trading, cancel contracts. The nuclear option, and the option that destroys trust in the market forever. Because once an exchange fails to honor delivery, who trades there again? The researcher had seen the legal language. Every futures contract has a force majeure clause. In the event of unforeseen circumstances beyond the control of the exchange, it's buried in the fine print. And it's about to become the most important sentence in the contract. Price discovery breakdown. Right now, silver trades on the assumption that paper and physical are interchangeable. A contract for 5,000 ounces on the SHFE equals 5,000 ounces you can pick up from the vault. But when the vault's empty, that equivalence breaks. Physical silver starts trading at a premium to paper silver. Not a small premium, a structural premium. The researcher had seen this in smaller markets. Palladium in 2020, rhodium in 2021, physical metal trading 15%, 20%, sometimes 30% above the futures price. Because getting your hands on the actual metal was harder than buying a contract. And when that spread appears, arbitrage dies. You can't buy the future and sell the physical because the physical isn't available. The whole mechanism that keeps prices aligned stops working. Two markets emerge: the paper market, where traders exchange contracts, and the physical market, where the metal actually changes hands, and those two markets start moving independently. That's not a price increase, that's a market fracture. The supply chain cascade. The researcher thought about the industries downstream: solar manufacturers in Jiangsu province, electronics fabricators in Shenzhen, medical device producers in Shanghai, EV battery assemblers in Anhui. Every single one of them operates on just-in-time inventory. They don't stockpile 6 months of silver. They order what they need 2 weeks before they need it. And they assume it will arrive, because it always has. But what happens when it doesn't? A solar panel factory misses its silver delivery. Production stops. Not slows down, stops. Because you can't partially build a solar cell. Either you have the silver paste, or you don't. The factory calls its supplier. The supplier calls the refinery. The refinery calls the exchange vault. And the vault says, we don't have it. Now multiply that across 400 factories. The production halt doesn't stay contained. It spreads. Upstream suppliers stop receiving orders. Downstream buyers stop receiving shipments. Contract penalties trigger. Force majeure clauses activate. And within 3 weeks, an entire industrial sector seizes up. Not because of a financial crisis, because of a physical shortage. The contagion path. Silver doesn't exist in isolation. It shares market infrastructure with gold, platinum, palladium. The same banks provide financing. The same trading firms provide liquidity. The same vaults provide storage. When silver fractures, confidence bleeds into other metals. Traders start asking, if the silver vaults are empty, what about the gold vaults? If the SHFE can't deliver silver, can the COMEX deliver gold? Suddenly, everyone wants to see their metal. Audits get demanded, vault inspections get requested, and the firms holding the metal start sweating, because some of that metal has been hypothecated, pledged as collateral multiple times. One bar, backing 3 different loans. It works fine, until everyone wants their bar at the same time, then it collapses. The researcher closed his laptop. He had mapped the entire fracture sequence. It starts with a vault hitting 0. It escalates to delivery failures, it spreads to industrial shutdowns, it metastasizes into a confidence crisis, and it ends with a market that no longer functions. Not temporarily, structurally. But here's what kept him awake. The market wasn't pricing any of this in. Silver was trading at $29 per ounce. Analysts were calling it a correction. Investors were treating it like a buying opportunity. Nobody was watching the vaults. Nobody was counting the tons. Nobody was asking the question that mattered most. What happens when the metal runs out? Because the answer wasn't a higher price. The answer was a market that stopped working altogether. And the timeline? 10 weeks, maybe less, maybe much less. The fracture was already forming. Most people just couldn't see the cracks yet, but they would, soon.